Ever wondered how to read a balance sheet? Today, your curiosity meets its match. Imagine you're standing in a vast financial forest and you come across a tree named balance sheet. This tree isn't just any ordinary tree, but one that carries the secrets of a company's financial health. You see, a balance sheet is like a financial snapshot, a moment frozen in time that tells you what a company owns, owes, and the investment made by the shareholders. Let's think of it this way. Suppose you're planning a trip. Isn't it essential to know how much fuel you have, the distance you can cover with it, and the amount of money you have for the journey? That's precisely what a balance sheet does. It's a detailed roadmap that reveals the assets, liabilities, and shareholders' equity of a company at any given point. But why is a balance sheet so important, you ask? Well, it's because it allows investors, creditors, and other interested parties to evaluate factors such as risk, performance, and financial flexibility. It's like a financial health checkup, helping you understand whether a company is in shape for the long run or if it's panting, struggling to keep up. So, to put it simply, a balance sheet is a crucial financial statement that provides you with a comprehensive view of a company's financial position. It's like the mirror that reflects the financial reality of a company, showing its strengths and exposing its weaknesses. Understanding a balance sheet might seem like a daunting task, but fear not. It's like learning a new language. It might feel a little tricky at first, but once you get the hang of it, you'll be conversing fluently in no time. Now that you know what a balance sheet is, it's time to delve deeper and learn how to read one. A balance sheet, like any good story, has structure. It's split into three main sections: assets, liabilities, and shareholders' equity. Let's dive right in and start with assets. Simply put, assets are what a company owns. Imagine you're running a lemonade stand. Your assets would include your lemons, sugar, cash in the register, and the stand itself. In a more complex business setting, assets could be anything from office buildings and machinery to patents and trademarks. Assets are typically listed on the balance sheet in order of their liquidity, or how quickly they can be turned into cash if needed. Next up, we have liabilities. These are what a company owes. Going back to our lemonade stand, if you borrowed money from a friend to buy your lemons and sugar, that's a liability. In a larger business, liabilities might include loans, mortgages, or payments owed to suppliers. Like assets, liabilities are usually listed in order of when they're due to be paid. Last, but certainly not least, we have shareholders' equity. This represents the value that would be left for a company's shareholders if all assets were sold and all liabilities paid. It's essentially the company's net worth. If you've ever heard the phrase, "you have to spend money to make money," this is where it comes into play. Shareholders' equity is money that's been invested into the business and its profits. Now here's the key part. The balance sheet gets its name for a reason. The total value of a company's assets should always equal the sum of its liabilities and shareholders' equity. This is known as the balance sheet equation. Assets equal sign liabilities plus shareholders' equity. It's a fundamental principle of accounting, and it's what keeps everything in check. So, in essence, a balance sheet provides a snapshot of a company's financial health at a specific point in time. It shows you what a company owns, what it owes, and what's left over for the shareholders. Remember, the balance sheet always balances. Assets will always equal liabilities plus shareholders' equity. Let's start with assets. These are what a company owns. In the world of business, assets are the lifeblood that keeps the operation flowing. They're the resources a company has at its disposal to generate revenue. And they come in two main types: current and non-current assets. First up are current assets. These are the resources a company expects to convert to cash, sell, or consume within 1 year or within its operating cycle, whichever is longer. Current assets are like the sprinters on a track team. They're quick, they're nimble, and they're designed for speed. Examples of current assets include cash and cash equivalents, short-term investments, accounts receivable, and inventories. Cash and cash equivalents are the most liquid assets a company has, meaning they can be quickly and easily converted to cash. Short-term investments are securities or investments that a company plans to sell within a year. Accounts receivable represent the money owed to a company by its customers, and inventories are the goods a company has on hand to sell. Next, we have non-current assets. These are the long-term resources a company has invested in and expects to use over a period longer than a year. Think of non-current assets as the marathon runners of the asset world. They're in it for the long haul. Non-current assets include things like property, plant and equipment, long-term investments, and intangible assets such as patents and trademarks. Property, plant, and equipment, often referred to as fixed assets, are the physical assets a company uses in its operations. Long-term investments are securities or investments held for more than a year, and intangible assets are non-physical assets that hold value, like a brand name or a patent. In a nutshell, assets, whether current or non-current, are the resources a company uses to generate revenue and grow its business. They are the building blocks that allow a company to create products, provide services, and ultimately turn a profit. So assets are the resources a company owns, both short-term and long-term. Now, on to liabilities. These are what a company owes. Liabilities in essence represent a company's financial obligations or debts. They come in two main types: current liabilities and long-term liabilities. Let's dive into these a bit more. First, we have current liabilities. These are the debts or obligations that a company expects to settle within 1 year or within its normal operating cycle, whichever is longer. These could include things like accounts payable, accrued expenses, or short-term debt. Imagine you're operating a bakery. The flour, sugar, and other ingredients you purchase on credit become your accounts payable, a type of current liability. Similarly, if you've used utilities like electricity and water but haven't paid the bill yet, that's an accrued expense. And of course, if you've taken out a short-term loan to buy a new oven, that's short-term debt. Now let's talk about long-term liabilities. These are the debts or obligations that are due beyond 1 year or the normal operating cycle of the business. These could be things like bonds payable, long-term lease obligations, or pension liabilities. Think about it this way. If your bakery needed a larger space and you decided to lease a new building, signing a lease for more than a year would create a long-term lease obligation. Or if you issued bonds to raise money for a major expansion, those would be your bonds payable. And if you're providing a pension plan for your employees, the money you promise to pay them in the future becomes a pension liability. In essence, liabilities are like the financial promises a company has made, the IOUs that it will have to pay off eventually. They're important because they give us insight into the financial health of a business. A company with manageable liabilities relative to its assets is generally seen as more financially stable, while one burdened with heavy debts may face financial challenges. So, liabilities are the debts a company has to pay, both in the short term and in the long term. Finally, there's shareholders' equity. This is the value that belongs to the owners of the company. It's their slice of the pie, the portion of the company's total value that they can lay claim to. But how do we calculate shareholders' equity? Well, it's pretty straightforward. You take the total value of the company's assets and subtract the total liabilities. What you're left with is shareholders' equity. Now let's delve a little deeper. Shareholders' equity isn't just a single lump sum. It's actually composed of two main components: share capital and retained earnings. Share capital, as the name suggests, is the money that the company has raised by selling shares. If you've ever bought a share in a company, you've contributed to its share capital. On the other hand, retained earnings are a little different. These are the profits that the company has chosen to reinvest back into the business, rather than distribute as dividends to shareholders. Retained earnings can be used to fund new projects, pay off debts, or simply build up a financial cushion for the future. These two components together form the shareholders' equity. But why is it important? Well, shareholders' equity gives us key insights into the financial health of a company. A positive shareholders' equity indicates that the company has enough assets to cover its liabilities, which is a good sign for investors. Conversely, a negative shareholders' equity could be a red flag, suggesting that the company might struggle to meet its financial obligations. Remember, shareholders' equity is not just a static number. It fluctuates as a company's assets and liabilities change, and as profits are earned and dividends are paid out. So, it's a good idea to keep an eye on this figure over time to track a company's financial progress. So, shareholders' equity represents the net value of the company that belongs to the shareholders. It's their share of the company's assets, once all debts and obligations have been accounted for. It's a clear and concise measure of a company's financial health, and an essential tool for any savvy investor. Now that you understand the basics of a balance sheet, it's time to learn how to interpret it. Let's talk about key ratios and metrics derived from a balance sheet. These figures provide insight into a company's financial health, helping you make informed decisions. First up is the debt-to-equity ratio. This metric is calculated by dividing total liabilities by shareholders' equity. It's a measure of financial leverage, showing the proportion of a company's funding that comes from debt compared to equity. A high debt-to-equity ratio might indicate a company is aggressively financing its growth with debt.